G'day everyone, welcome to this weekend update for markets around the world. And the question that I pose this week is, are markets topping? Now, I've said since the latter half of 2013 that this year would be a more volatile year because we're now into year 5 of a bull market, so that would be perfectly normal. The further a market advances, the more volatile it tends to get towards the end. So I'm expecting that we'll see a couple of decent corrections this year, probably at least 10% or more. We haven't seen one of those for quite some time now, so that is what you really should expect. So in posing this question, I'm not signaling any change in my view at all. We were always going to have, I think, at least a couple of corrections during 2014 of 10% or more, and it could well be that we're working up to one now. Seasonally, April, May tends to be a period where markets can turn down, so it fits with that seasonality. But I stress that there is not confirmation of this happening as yet. So these are just some early signs to look for. So let's have a look at a summary of what happened last week. And the S&P lost 37 points, which is about 2% on the week. So it was a bit of a decline, and it's a little unclear at this stage whether it is a topping process or not unfolding. So I need to stress that I'm not saying that we're into that phase just yet. We do need some confirmations, but it's a distinct possibility. Now, offsetting that is the fact that the Russell 2000 index actually rose on Friday night and still looks reasonably sound. Now, normally what you'd expect when a market starts to top out is that the Dow Jones and the S&P index tend to turn over last because they get held up by the really large cap stocks. And the markets or the indices such as the Russell 2000 will tend to turn down first because they're comprised of stocks in the 1,000 to 3,000 market cap order of size. And so it's the smaller cap stocks that tend to fall first as people get out of those and they hang on to the big stocks till last. Now, that is not happening at this point in time as yet. So therefore, there's no need to panic, but there certainly are some other signs. The key to me is the bond market in America. If the bond market turns up and breaks into a new phase 2 bull market, and for anyone that doesn't really understand what phase analysis is about, then you might want to get in touch with me to find out because it's pretty important. But the key is the bond market. Now, if the bond market goes into a new uptrend, then that means that money is seeking out a safe haven. Money tends to go into bonds, it tends to go into gold, and it tends to go into high-yielding stocks such as real estate, trusts, and utilities, gas and power companies and that sort of thing that pay a high dividend and tend to be less volatile. So that's where money goes. Now, if it's going there seeking a safe haven, then obviously it's money that's a bit frightened, and therefore it's almost certain that that money is coming out of equities. So if the bond market rises, then you're going to tend to see equities fall, particularly at this stage. Now, I know the two of them went up together during 2011 and 12 in that transition where people started to move money back into the market, but we're far more advanced now, and people have got over that fear of the GFC and are looking for higher levels of risk and higher returns. If the money starts going back into the bond market, then it signals a change in sentiment. So the key to watch is the bond market, and we'll have a look at a chart of that. So if the bond market does break out in a new phase 2 bull phase, then look for a 10 to 15% correction in stocks as being highly likely. So let's take a look at some charts. We'll start with the S&P index. Now you can see it was mostly down last week. We had pretty much 5 sessions lower, nothing overly dramatic, and certainly only only down a couple of percent. But let's pan back and have a look at a bigger picture. So if the market were to correct from the last kind of significant fall that we had, which was November 2012, so it's about 16 or 17 months ago, then we'd be looking for a pullback probably to at least this 1678 level. Now that would represent a 10% pullback in the market. It would be a 38.2% retracement. It would bring it back onto this previous high from May 2013. So all that lines up pretty well. So if we're going into a bigger correction, then I think that'd be the target, 1678, which is another 160, 170 points lower than where it is now. Now, if that doesn't occur, and all we're going to get is just another little downtrend, as we've had several of these. As you can see, we had one here in August, we had one here in September of 2013, and then we had another little brief one in at the end of January of this year. So if we're going to get another brief little bit down, then we'd be looking at targets between 1827 and possibly down to 1792. So not that much further down than where we are, and the impact on stocks in general would be fairly minor. But if we are going into a bigger correction, then I'd be looking at below 1700. Now let's have a look at this bond market possibility. Now, this is one of several ETFs that you could look at. So if we pan back here, you can see that the price of bonds has been falling, so that means the yields have been rising. But we've now formed this phase one base. So it's forming a base here between roughly this level and this level down here. Okay, so there's the base that we've formed. This also picks up these lows in the bond market back here in October 2011 and also March of 2012. So at this point in time, all it's doing is still consolidating within this phase one base. But at some point, I think it's highly likely that we will see a breakout of this zone. It'll either break to the upside or it could break to the downside. We don't know at this stage which way it's going to be. But if it does break out to the upside, then look for equities to correct by a more significant amount. So that's a key one to watch. The ASX 200, we had a pretty awful week. Finished poorly on Friday. Index fell by 133 points, or 2.4%. The losses were across the board. Every sector: banks, telecommunication stocks, mining stocks, the whole lot. The only sector that was resilient was gold stocks. And it was largely fears over China is really the major drag on our market. It's impacting the resource stocks, and it's impacting a lot of other stocks as well, because it's seen as affecting our whole economy. So let's have a quick look at our index. So you can see fairly nasty day on Friday, but again the fall hasn't been all that great at the moment, and it'll track along with the S&P. Now moving on to gold, and this I've been talking about gold now for 6 months, and this really is the big story. Gold gained $43 on the week. It closed higher on every session last week, and it definitively cleared the 1340 resistance level that I've been pointing to for some time. The next target, again, as I've been outlining, is 1440. If it closes above there, then we're really going to see a surge in gold. Now, the gold miners index, the GDX index in America, also broke its first resistance level, but there's another one which is probably a more important one at $31.50. So confirmation of a significant move in gold stocks will come when the GDX index breaks above 31.50. So let's have a look at those couple of charts. First of all, we'll look at gold. So you can see, if we just pan back here, we had some resistance here at 1270. It consolidated around that level for some time, about 2 weeks, broke above it, got up to this 1340 level, which was the 61% retracement of this run from 1440 down to the lows. It consolidated. You can see it stayed in a band around that level. It didn't just move straight through it, so it consolidated in a band just under that level for some time, and then broke out basically last week. Let me just move that up a little bit. So there's that consolidation band, and then the last 3 days of the week you can see that gold moved higher. Now the next confirmation is 1435, 1440, and after that gold would really well and truly have confirmed the new uptrend. I think it's pretty much a given already, but for the more conservative, that's what you're looking for. Now here's the GDX index. We had some resistance at this little peak here. We've closed above that now over the last couple of sessions. Gold may continue just to chop around and consolidate underneath this next resistance level, which is here. So we may get some consolidation in this band here between $27 and $31. That could go on for a few weeks, could even conceivably go on for a few months. But I think the signs are very strong that we're going to get a breakout in gold stocks globally. And if that happens, or when that happens, I believe it's just a matter of when, then we're likely to see a fairly explosive move in gold stocks. Silver also strengthened a bit, 2.6% on the week. It's lagging behind gold at this stage, which is a little strange, but as these trends gain strength, then I expect silver to outperform gold. Now, copper was down very sharply to below $3. It had been holding above $3.20, $3.25 for a long time. This was a very sharp move. It's directly related to fears over China. But what's actually happening in China is there's some funny deals being done using iron ore and copper as collateral. And the Chinese government is trying to stamp out these practices and also close down some inefficient steel mills. So the consequence is they're putting pressure on these iron ore traders that have been doing some creative financing deals using commodities. So what we've got in copper and iron ore is not a natural market. It's not a market that's responding to the normal laws of supply and demand. It's being manipulated and it's being forced and pushed in certain directions. So I'm not sure that we really need to place too much emphasis on this sudden fall in copper. We'll just have to wait and see. Now oil remains steady, just a tick under the $100 mark. So here's the copper chart. You can see it's fallen very sharply from $3.20 down below $3. I'd want to see some stability coming back into the copper price, and I really think that it probably will. I think a lot of these things are due to short-term Chinese government efforts and also to just the normal buying patterns around the Chinese lunar holiday, or the holiday, the new Lunar New Year, I should say. So finally, just to finish off, I've been saying all along 2014 would be a more volatile year. You want to watch for a phase 2 breakout in bonds. That's important. And corrections are a great opportunity if you're prepared. Now, most people aren't prepared. They wait until things kick them in the backside and then they scramble around and try and figure out how to do something about it. And generally all they're doing is trying to get out of the way. Whereas if you're properly prepared, you can not only get out of the way and protect your capital, but you can also make some serious money as well. So my philosophy has always been protect your capital first and foremost, and then you can position yourselves very nicely then to take advantage of whatever trends emerge. I'm not into predicting. I'm into monitoring and responding to whatever the market provides, and that's always worked pretty well. Now, gold stocks almost certainly into a new phase 2 bull market, but they may consolidate before the real explosive move. That could take weeks, it could take months. We'll just have to wait and see. Now, the process of making money from gold looks easy, but I can tell you it's not. The fact that gold stocks are almost certainly going into a new phase 2 bull market does not mean you can just buy some gold stocks and sit on them for 12 months and reap the rewards, because gold stocks are extremely volatile. There are better gold stocks than other types of stocks. In fact, there are very few good ones. And also your psychology kicks in. And when gold stocks start to move around and you're looking at some short-term losses, then generally traders make some fairly uninformed decisions. So it looks an easy process, but it's not. Most people would benefit a huge amount by getting a bit of input and a bit of guidance on how to trade gold stocks. So for anyone that's interested in doing this properly, taking advantage of the money and the opportunities that's going to unfold in 2014, there's my email address. Feel free to get in touch with me. And if you want more information on what we do for non-members, then that's the web address. For members, of course, you're already being positioned to take advantage of all of these new trends. So look forward to 2014 with a great deal of excitement. That's it for this week. Cheers.